Hi, and welcome to the Gap Savvy podcast, where we translate the fast evolutions of tech into what actually hits the books. I'm Angela Liu, a former instructor with KPMG's National Office, product strategist, and founder of Gap Savvy. I've closed the books, written the memos, and even helped build an ERP from scratch. I'm here with my co-host, Devon Coombs, advisor to the CAO and lecturer at San Jose State University.
I'm excited to talk to you about today, and I want to get your perspective on is when everyone's talking about the AI bubble. Primarily, I shared a graph with you a while back, or this chart, where they're showing all these reciprocal transactions. One company, I'm going to try to not say companies so we don't get in too much trouble here, but like one major hyperscaler might invest in one major infrastructure company that then in turn invests in that hyperscaler, which then makes another investment to purchase AI products from an AI foundry company. So you might have these three different parties where they're showing hundreds of millions of dollars of, or sometimes billions of dollars of investment, backlog, and revenue, but they're all between that small ecosystem. And it'd just be like you and me, right? Like, hey, Angela, I'm going to give you $1,000. And then tomorrow you give me $1,000 and we'll both say our company's made $1,000. There's a question if there's like real substance underlying those reciprocal transactions. You're an expert in technical accounting in general, your background in national office. I've been in those hyperscaler environments and I found it very lacking personally that the discussions around this looks shady. Like that's generally what people are saying. I don't know if I trust this and this is a bubble. And I thought it'd be really fun to have a more grounded conversation of what is actually true there. What are the risks from your perspective, the real risks, and what isn't as big of a risk as people are stating, And so that'd be fun just have a discussion on that while it's top of mind for everybody.
Yeah, I'm going to break your anonymity for my sanity because that's now recorded because my brain can't work in non-specifics. So I'm going to now add them in and we can edit them out later, but I'm talking slowly so they're easy to edit out.
Well, let's just be specific, right? The chart's out there, right? McKinsey and
whatever. Actually, this concept of an AI bubble, and there's this chart with like OpenAI, NVIDIA that's selling the hardware, these hyperscalers, or basically who owns the cloud and the vertical and the infrastructure that these things have to get built on, where they get their ad revenue. And then these, oh my gosh, with like the core weaves, right? Or like leasing of the data center. So we almost need this picture. Maybe it'll pop up right now. Because when we talk about the AI bubble, I think that the crux of it is there are these huge numbers flying around, like massively huge numbers that typically companies can't pay for. But if everyone is selling to each other and they're all in some way related entities, and I use that word not necessarily in the accounting context, but they're obviously related because they're buying and selling from each other. The question is there any real value in the transactions? If in your example, you give me $1,000 and I give you $1,000, is it just like funny money where we both get really awesome like P&L or balance sheets, right?
Exactly.
Okay. And since the chart is already out there, we did not draw this thing. We are just commenting on it from an accounting perspective because that's the lens we have, because there are some fun little nuances in accounting, both in VIE accounting, in revenue accounting, in lease accounting. And you have to know the nuances of the roles of how you could not manipulate, but account for things in a certain way that is the only transparency that will show up on any sort of financial statements. And many of these companies are private, so you don't even get that. So the only ones that you're seeing are actually the public companies publish probably the bare minimum of what they need to. Okay, so let's start there because I just needed some real names as we were talking about it. So Devon, explain to me maybe that first part of the paper that you wrote, like where are the fun little tech accounting nuances and what kind of relationships are there?
Well, yeah. So one of the first ones where I think it's not in the chart. And so I'm going to start with what's not in the chart that I think is implicit and everyone really needs to think about. And the first thing, with ASC 606. So in our revenue recognition assessments, how do you pass step one? How do you actually have a contract? One of the biggest hurdles that people kind of look at the paperwork or like a checkmark exercise, that's really important is collectability. Is that what you are doing? Does it have commercial substance and is it collectible? And to be collectible, it has to be probable. I believe that you'll collect it, right? And there has to be a degree of certainty to this. And there's actually ratios that are best practices that are applied. And to me, the first risk is Well, there's these new companies, OpenAI, Anthropic, you name it. And OpenAI recently in the news was talking about how they have $1.4 trillion in commitments that they've made. And the first thing that stands to me that no one else is talking about, I wish more people were talking about, and I want to get your take on is let's say Anthropic has a similar commitment, OpenAI has a commitment like this, Grok, all these AI models are making these large commitments. How are other companies certain that that's actually collective?
Yeah.
Because
Now,
if I'm
I do want to slow you down because I noticed that when you started saying OpenAI, Anthropic, then you mentioned Grok, you hesitated because you didn't include like a Gemini. And I actually think that's really important because Google's Gemini, Google has been around for a very, very long time. There's obviously an ad revenue stream that pays for most things. Same thing with Meta, right? So you kind of hesitated because you're like, there is something about these new AI companies where there's just a ton of VC, private funded money going into them. And there is a lot of money in the world, especially when you live in like a San Francisco or Silicon Valley. But for those companies that don't have that weird big ad revenue stream, can you say that a 30-year contract or a 10-year contract is collectible? Because where is it coming from? It's not coming from ad revenue. Where is it coming from? Is that sustainable for not just 1 year, 2 years, but 10 years, right? Because these contracts are long. Is that a good way to frame it? Because I
yeah,
didn't comment on your
you framed it completely correct. Sorry to cut you off, but I think Google has a great business model here because we know AI is expensive. We know it takes a bunch of data, it takes a bunch of money. You have to buy these expensive GPUs, and Google has the money. Google can back itself. The Google has the revenue streams. It's profitable, has positive cash flows, and that's why I think Warren Buffett recently made an investment in Google largely because it does have this competitive mode advantage. I haven't seen, and I think OpenAI and these other companies are very articulate that with their burn rates, that they're profitable, that they have a way to get cash flow positive. And when you're making a $1.4 trillion commitments, how are you going to pay for those commitments if you don't have any positive cash flow?
operating cash flow, right? Not just cash flow. The question is, do you have operating cash?
Yeah, exactly. Which they don't. And then how much is $1.4 trillion? That's a lot of money. Like you could raise 10 billion, maybe. That's still a ton of money. 100 billion, but 1.4 trillion. So are you saying OpenAI is like one of the top 10 companies in the world in valuations right now? They've only hit their stride the last couple of years. That is a trick to me. Like, how would they actually fund that? I think I was looking, that's like a large percentage of the US GDP. It's not a small amount of money, and they're making these commitments, but that's not so the risk of bankruptcy for them or the risk that they might not be able to pay all their commitments isn't the larger the risk there. The risk is, well, then OpenAI makes a commitment, I don't know, and think of Microsoft. If Microsoft then reports 100% of that commitment is backlog and revenue, is that an accurate representation of future cash flows?
Yeah. Now, that OpenAI and Microsoft relationship, right? You're saying, because that's well known, that partnership, right? You're saying that why would that be included in Microsoft's revenue at 100%? Because I want to get into the accounting, right? Like when do you consolidate an investment? When do you take a portion of investment, right? Like there's specific accounting rules of what you have to report depending on the size of your investment and your significant influence of like that 20%, right?
Yeah, an interesting way, and where it would be fascinating to go. Like, what if OpenAI and Microsoft were consolidated? I think that's an interesting thing. So for the viewers, what if we were to merge all of the losses of OpenAI with Microsoft? What would happen to cash flows or valuations as a whole from an accounting perspective? I think Microsoft would look a lot less attractive. They would lose a lot of their, like, any revenue coming from OpenAI. And I'm not sure how their financial statements are laid out or how their consolidation is working as of today, but any revenue from OpenAI that Microsoft is generating would have to be washed. They couldn't recognize any revenue that they were making from OpenAI. OpenAI couldn't recognize any revenue that they're making from Microsoft. Those would get washed in intercompany transactions ultimately if they were consolidated. But all of the losses of OpenAI would be on Microsoft's books. It's like a shell company. You have this company that's taking on all these losses that if you were to look at a consolidated basis, because that's how they need the cash flows, there's actually real risk that the overall picture would be much worse.
VIE accounting is variable interest entity accounting, which even after I break out that acronym almost means nothing. Yeah. Variable interest, meaning I have a variable interest of how much of this entity that I own. And there's like that 20% number where like, I own more than 20% of this entity? I don't think Microsoft owns 20% of OpenAI, and I don't think OpenAI owns 20% of Microsoft.
I think they were brought up in the VIE disclosure. I don't believe that they've crossed that threshold yet. And that's something that we can check after we have a more robust.
And if you don't cross that threshold, you don't consolidate, meaning your losses are your losses, your wins are your wins. You still look like a third party transaction. So I still get revenue and I still have expenses, right? Does that nuance in accounting make it so that everybody can still be profitable because that consolidation or that 20% hasn't been tripped?
Yeah. And well, the interesting thing about the VIE accounting is there's more qualitative measures too of control. Like we talk about control a lot in accounting. VIE is a very interesting one of, does Microsoft actually control OpenAI? And we look at certain indicators, and the 20% indicator is one of them, right? But there's other indicators like, do you have all the board seats? Do you control their complete revenue stream? Like, are you their only customer? There's certain things where it's like, yeah, even though you don't own everything, we should consolidate. It's very interesting because it just seems to me as the third party that we're walking this line a little too close. Like, okay, Microsoft has openly invested in OpenAI. They openly have partnerships and revenue streams. I'm not just talking Microsoft and OpenAI. I'm saying all of these
Examples, because it's easier for people to comprehend what the hell we're talking about.
The idea here is that, well, okay, if we have reciprocal transactions, Microsoft's investing in OpenAI. OpenAI is investing in Microsoft. They have influence over the business. They have partnerships. At what point do you trigger control? At what point do you say like, hey, this is really one business? Another way to look at it, what happens if OpenAI can't pay their bills? Is Microsoft going to buy it? Is Microsoft going to consolidate it? And then what does that combined business look like? And is it a better business or worse?
Yeah. Well, so as you're talking about this, there's like the accounting and then there's my gut check. And I'm like, well, clearly Microsoft doesn't control OpenAI. Like the way they act, right? Like clearly they have very little power. I mean, like, I think the actuality of it is like, I don't feel like that's the case. Also, Microsoft kind of, is diversifying and now has also that partnership with Anthropic, which I think is exciting because all of us wanted Excel to get better. And we actually started seeing it at the end of the year. Claude is insanely good at reading multiple data tables and drop-down menus and relationships across tabs, which I'm so excited by. Agent mode and Copilot has gotten weirdly better. So whatever is happening in the world, I'm for it. Thank goodness we're finally in the coding language that accountants can use. Now, neither here nor there. That's that VIE piece. We talked about that revenue piece, which is like, is this even a legitimate contract? Because you have to kind of pass that. Then you go into the VIE. The other thing you wrote in your article was actually about this nuance in revenue accounting of when you have consideration given to a customer. So let's dig into that, of the nuance of consideration given to a customer. And I'm going to give the textbook example that people do in accounting, which is grocery stores. I know it's not sexy compared to the AI discussion that we're having, but basically like that end shelf unit, marketing development fund, or like when you have someone that they're both your customer, like they're buying your goods, but then you're also paying them for like ad space or something like that. But essentially, yes, you're my customer and I'm giving you something back. But whatever I give back to you, I need to make sure is at market fair value, and anything above market fair value. So like the cost of the marketing, the cost of the signs, the cost of the end cap, right? If I can't say specifically what this thing is going for, and some of it's just related to goodwill and like branding, and like, I just want to be a part of this transaction, all of that is actually contra revenue, meaning you can't count it as revenue with contra revenue.
I always want to say though, I'm a big believer in substance over form. Just because things seem a certain way doesn't mean that's the reality. And who knows, right? If like Microsoft owned 100% of OpenAI and didn't tell anybody, and then Microsoft also invested in Anthropic, you could still consolidate OpenAI. And again, I'm not saying this, right? But I'm just putting on my trust but verify hat there for a second. I agree with you. On a gut check, I don't think that's a bigger risk. And collectability is a big risk. And then this is also a very interesting risk. And so these, I call them balance of trade initiatives or reciprocal transactions. Again, the technical term is payments to a customer. And there's two pieces there. So there's a fair value assessment. And the other risk is there a valid business purpose at all? So the business justification. So for me, let's go back to our example. I give you $1,000, you give me $1,000. We don't do anything for each other. Is that revenue? Well, no, it is. There's no commercial substance to it. You didn't perform a service. I didn't perform a service. You couldn't say that's a revenue arrangement, or maybe it's a loan or an exchange of funds, but it's not a revenue relationship. Previously with shelfware, where companies would sell CDs of products and you'd put them on the shelf and never sell them again. This happens a lot in resale relationships as well, the bill and hold kind of relationships where you sell something, but you actually have a return rate attached to it. If I give you a bunch of product, but you can return it at any time, can you recognize the revenue? Well, if you can return it and you only make money off the resale, it's questionable if I should be able to recognize the revenue related to the transfer to you. And so that's where I want to start. Is there business substance to these transactions? When we are selling AI, what are we selling? Like capacities to chips, compute, for example. How do you actually know as an observer if that compute is actually being utilized or not? So let's say you own your own company, Angela, you own your own data center, your own chips, your own compute capacity, and your cloud company. And I say, hey, Angela, I'm going to give you $1 billion for your compute. And in exchange, you give me $1 billion to use my AI models. I'll be the AI company.
Mm-hmm.
How does a third party come and validate that I'm actually using your compute and that you're actually using my AI models? And I know that because I've been an advisor and I've been on the deals desk and I've audited these transactions. You have to take management's assertion for it to say, yeah, don't worry about it. We're going to use the product. But there's no real way. Like, I'm not going to go to the data center and actually see if those chips are actually being used. I'm not going to go and check and see if all of your AI is like all your people are actually using that AI. So there's a lot of underutilization. And so there's a mismatch of principles there before we even get to the fair value conversation, right? There's an easy loophole there of someone could easily check if I perform services for you or not. And we could check and be like, hey, if I was going to buy one of our businesses, is that the quality of earnings? Is that revenue real? There's no real way to validate this for AI versus compute. And that's the first risk of those transactions. The second is the fair value. Then let's say, let's give the benefit of the doubt, you are going to use it. Well, how do we price that? And is that actually at a fair value, especially if it's not an arm's length transaction anymore, because you have this reciprocal nature of it? And how do we price these transactions? Because in theory, let's go back. If you sell me the service, right? We're going back to those services of consulting. We'll try to keep it simple. If you go back to a consulting service and you say, Devon, I'm going to perform $150 of services to you, but I'm going to charge you $100. What does the guidance say? Well, the guidance says, well, I only can recognize 50. It doesn't matter. The recognition has to be for the portion that had commercial substance.
Yeah, so the 50 gets recognized in revenue, but the other 50 is contra revenue.
Because you're paying it out, right? So it actually would net out.
Yeah. Okay. I feel like I'm starting to get this, but let me see if I could play this back to you, because we started out talking about, is this revenue arrangement? But then we actually jumped into a different set of guidance, which was like investments.
Yeah.
Right. So like that Microsoft, OpenAI, Anthropic thing that we just talked about was investments. That's not even like in revenue. That's just like, I'm like investing in you as a company, kind of ownership control model. So now we're back in revenue recognition guidance. So we're also buying things from each other. You brought up this build and hold analogy, which is fascinating. I had actually not thought about it in that, which is like, I sell you, X amount of capacity. You sell me X amount of AI model use. Are you using it similar to bill and hold, where it's like, it's the end of the year, I got to make my mark. I'm going to sell you 100,000 units of this thing, and I'm going to keep it in my warehouse, and you'll use it when you need it. But the loophole in physical goods way back when was, oh, I just bought 100,000 units, so I made my number, and then I'm just going to return it all, right? And so that became something that auditors would look for. But in this case, it's an intangible product where, like, there's no way you can audit if those GPUs are being used. There's no way you can audit if the token in the AI models are being used. Plus, the prices are changing all the time. This stuff is literally getting made up right now. So, like, the cost of tokens can dramatically increase or decrease in price, right?
Inflation, fluctuations. Yeah.
Yeah. Right. Because like we've almost created this currency in tokens and GPUs, and they were worth X amount per unit. Now it's worth this. So even in these transactions, which is like, are you even using this thing? Then you go into this other space, which is like, in what is it worth? Well, it was worth this last month, but it's worth this month. So like, how much is the net of revenue and how much isn't? So like, there is so much gray in judgment in all of these that I almost feel like the accounting guidance, I don't know if it's going to do it justice, but is that right about how I just connect those three concepts that we just talked about?
Yeah, yeah, you nailed it. And you add in collectability too. Like, and so you see, like on an isolated, you nailed it. An isolated one of these might be like, hey, maybe I'm just kind of overthinking it and I know too much about technical accounting. But then we start layering all of them. There's these consolidation risks. Maybe that profile is low. But then there's also these reciprocal transactions. But we can also, it's not just pricing of the transactions, but it's also, are they actually even being used? And then follow the incentives. Like where are how are commission structures paid out? Well, by signing new contracts, by consumption. So there's incentives in order to be able to sell these products. Well, there's also incentives to show growth and earnings to report backlog related to them with non-cancelable contracts. There's incentives to show growth and profitability. So there's incentives not to have contra revenue. So follow the incentives. It seems reasonable to me that there's a moderate amount of risk in this environment. And we haven't even talked about, like you mentioned, chips and models are changing so fast. Well, does that mean depreciation and useful lives on these products should be much lower, which should increase the costs of them? When we hear and know that most of these companies are actually extending the useful lives of their chips in order to, whether saying accurately represent the useful life of the chips, but in reality, that doesn't make sense with what we know of the economics. Everyone wants the newest chips, the fastest chips. So it seems like a profit or revenue or earnings types of smoothing behavior. So all of these together just make it seem to me like, yeah, there's some real risk in the system.
Yeah, and these companies are not necessarily reporting publicly, right? Like, I think NVIDIA's public. Trying to think of who else, like, Google's obviously public. Who else in this ecosystem is very public? Oh, Microsoft, right? But they also have a lot of operating income from different places. So where this is gonna sit is harder probably to find the financial statements, but there's only partial there's only partial places that would need to be publicly disclosed. Is that also because like, there's, like, the people feel like there's a bubble, and then there's, like, how could you possibly verify it in theory? The accounting should kind of, like, tell you a little bit, and then obviously cash flow should really tell you, but that's also kind of part of this weird little mess, right?
Yeah, we have Anthropic, we have OpenAI, but how many AI startups? Like, there's so many AI startups right now that are getting tons of funding. And then the issue isn't the public companies. The issue is that the public companies are making the most of their revenue growth from contracting with these small private companies that aren't subject to the same regulations. And so if I'm at a big public company and is it reasonable for me to do $1 billion contract with a company like Anthropic, let's say, or OpenAI, and then say, yeah, that's high quality backlog and revenue, and I'm going to take 100% of that as backlog and revenue, when that's practically a brand new company, or at least a company that just hit its stride, and we know that they're committing hundreds of billions of dollars to other companies. Like, how can that's distorting the quality of earnings, that's distorting the revenue, that's distorting backlog, in my view.
How much revenue is actually being shown by these companies? Like, minus NVIDIA, who is showing a lot of revenue related to AI products right now? Minus the private ones. And I don't know the answer to that, but that would be quite interesting to me because I feel like there is it might be how these private companies are valued. There is a lot of real value being driven there. How much is what we're talking about in question.
Yeah, yeah,
In the ones that are actually disclosing publicly, like, who's making a ton of real publicly reported revenue on AI right now? I don't know.
yeah, yeah. I don't know either. I'm not aware of any major winners, which that's the weird part, right? If there was a big winner, you would expect someone to be starting from the rooftops. I figured it out. I'm making a ton of profit with AI, and everyone bet on me. But no one's cracked the nut, except I think Google has cracked it because they have the ecosystem, right? They have the ecosystem that can absorb the costs related to AI, which is a whole other different discussion. But there's a real risk to let's me put another hypothetical to you. If OpenAI cannot become profitable, let's say they can't generate that, they have to live off of money from other companies. And let's say most of Microsoft's revenue growth was related to OpenAI because they are selling things to OpenAI or have backlog related to OpenAI. Is that revenue growth real if OpenAI can't afford it in the long term? That's the risk that I'm trying to get to, is down the road, is that revenue growth real or is it inflated partially due to these reciprocal transactions?
Yeah. And then that's why I was asking that question of like, how much revenue is really coming in to these publicly traded companies
Exactly.
that are revenue like things like I would think like again, I'm thinking accountant brain, and I know Microsoft does more than this, but like there's their Office suite and Excel, right? And it's just like that's the tangible thing that's really making a difference in my life. I don't think it's making them a ton right now, but I know that Azure's a cash cow, right?
Yeah.
And so similarly between a Microsoft and a Google, you have all of the infrastructure that all of AI is being built off of. So like that's real. I think that's real value.
Yep. The
So
cloud.
like, application level, there's no real winner except for the base models, which are all private right now, except for Gemini. But yeah, it's interesting in terms of the overinflated revenue. And I feel like actually the risk might even be more the overinflated valuations, which gets back to that investment piece. I don't know which one's the bigger risk, or maybe they're all related.
Yeah. Well, and I think we're going to see it play out. And who knows? We're all speculating here, right? Because there isn't access to public information about OpenAI, which is funny. The name's OpenAI, but then we don't actually know what's happening. It's not that open. Or Claude and Anthropic or any of these other AI companies. But I think it'll be very interesting to see how this all plays out. And especially since most of the people I talk to agree, there's probably going to be only one or two winners here. Like we don't need four different LLMs at the end of the day. What if there's one big LLM or two big LLMs that win? What happens to the other two? And then what happens to the commitments that those other two have made to all of the other companies? And then what happens to the revenue growth of those big public companies? And then what happens to valuations? And does that mean the government has to come in and bail out some companies, right? That's where I'm seeing it. Seems overinflated, right?
My hypothesis, completely mine, could be totally wrong, is that the bet is that there will be one winner takes all. That is why people are just throwing money at building the infrastructure, trying to win the model race. And it's funny because when you drive down the 101 in California, right, you can always tell what the real hot topic is because the billboards always change,
I'm sure.
which is like, okay, if at the end of this, because I think you're right, like, what if people can't honor those 30-year commitments or 10-year commitments? Because this thing is moving crazy fast. And if there is only one winner take all and someone gets world dominance, which is terrifying, but whatever. But like what then from an accounting perspective, those other contracts would fall through. I don't know if the accountant role is so interesting because you can't save the world through it. You can only try to see what the reality is through it, right? To the best of the way that our markets work to create financial transparency. The risk is very high, which I think is really what you tried to highlight in that paper, right? Which is like, there's a lot of places to fudge around, and we only can see like small corners of this equation. And it feels like something big is happening. We don't know really where the money, like, we know there's a lot of money in the system, and that's real money. But like, if it's winner take all, if it really is that, then we're going to have a lot of weird financial statements at one point when that winner takes, like, when that happens.
Yeah, and that's all I asked for at the end of the article is it'd be nice to have some more transparency. That's all. And like, if I could go to the SEC for a day and be like, hey guys, when we start seeing this, maybe that means companies should disclose major reciprocal transactions so we can make better judgments around it. That might be a helpful disclosure to understand. And if companies resist that, I think there'd be a question of, okay, would it change our interpretation of the markets if someone was like, oh yeah, 30% of our revenue is generated from reciprocal transactions. I don't know. But for me, it's like, did that change your quality of the earning? Is like that there's such a concentration or more disclaimers and disclosures around the VIE guidance of, hey, maybe you have smaller ownership interests, but if you have other partnerships, do we have more disclosures related to what those partnerships are like and what happens in certain cases, right? Just some ways that we can understand the bigger picture because it feels a little illusionary. It feels a little too sophisticated. And whenever that happens, I'm a big purist of business. Like businesses perform a service, solve a pain point for a profit. And if you can't really understand, if it starts getting convoluted, it's probably not real business anymore. It's probably inflated in some way. So yeah, again, business valuation is driven by cash flow, positive cash flow, right? So
Yeah. And it's interesting that you said, like, what do you really want from this? And if it's like more transparency or more rules around this, there's always that part of myself inside me that fights, like when I was a first year accountant and I was started my audit career, I was like, oh my God, my full job is a speed bump of corporate America. Like all I do is down. And I was like, ah. And I say that with the humility of being a first year going into the markets and having to ask my clients for like reports and like obviously being new and not understanding everything. Fast forward later to my career and seeing like understanding the international environment and like how special the US is that we even have like the NYSE. We have these markets. They're all based on trust. Like just truly they're based on trust.
Yeah, exactly.
Fact that we have auditors that are going out there and doing this thing, which like, yes, is super unsexy. But like at the end of the day, the reason why we can lend like that in the public market is because of a fundamental trust in the structure that is built within the governmental structure, as unsexy as all of that is. But that's what's so interesting about the thriving private market in this space.
Yeah.
That I think the feeling that you're feeling is this seems too convoluted. Whenever there is convolution and you can't explain, I mean, there's very complex subjects in the world, but you should be able to grasp this. And when you can't, and there's so much money flying around, like what can be done about it? Or would that change anything? Like, would it stop anyone from investing in OpenAI or taking a job there? Probably not.
Oh,
But I think we're almost talking to how bad is it?
yeah,
Right?
yeah, we don't know,
We
and that's the
deserve, well,
problem. It's
how
like
bad is
we want to know. Like, can someone give me some more information here? Because it seems important. And any time in history that we've wished we knew more information and we didn't, there's tends to be we didn't get it. There tends to be drops. That's like there's incentives. It goes back to the incentive conversation. I want to leave with maybe think about it too, just from like how insane is it to give a 10-year commitment and base your backlog? We're making assumptions here that they're basing backlog off this and revenue, but I think most companies are just claiming that this is a big driver of growth. Like if you were to enter in a 10-year contract with a company that just hit its stride in the last few years, like that's like a mortgage. And I really would doubt that these major tech companies are performing the same kind of financial analysis that you would need to get a mortgage on a $1 billion commitment. Like they're not having the same scrutiny related to it. And how likely it is it for all of these companies to exist in 10 years? It's not. And so if we're recognizing 100% of that, it seems wrong, you know? But
yeah,
yeah,
there will be winners and there will be losers. So why isn't it showing up?
exactly.
Yeah.
But yeah, thank you. Thank you for talking to me about this. I'm not sure if people will even follow. I know it's pretty complex and technical, but I trust people. I trust the intelligence of the community. And yeah, it would just be interesting. Maybe we're out there. If people know anything, I'd love for them to put comments below if I misspoke anywhere. And this is more just an exploration of trying to find the truth of this and learn more. So this is fun.
Yeah, totally fascinating. I love it. I feel like I learned a ton. So curious what people tell us.
Yeah. Thank you, Angela. And thanks. I learned a ton from you too. I appreciate you pressure testing this with me.